What if I told you $1,000 was enough? Enough to rewrite your financial story if you follow the plan I'm about to show you. Not a get-rich-quick gamble. Not a casino-style double-it or blow-it fantasy. A precise mathematical path that 99% of traders never even bother to calculate. Here's the reality. The difference between ending the year with $1,000 or $100,000 isn't about finding the perfect trade. It's about compounding with ruthless discipline and avoiding the psychological traps that destroy almost everyone before they get there. Most traders think they understand compounding, but their results prove otherwise. By the end of this video, you'll know the exact formula, the exact risk plan, and the exact mindset shift that turns $1,000 into $100,000 without blowing up your account on the way. You've probably seen traders post screenshots of massive gains, 5K days, 10K weeks, 100K months, and thought, yeah, but they must have started big. Here's the uncomfortable truth. Most didn't, and the ones who did had one thing in common. They followed a growth plan so simple and so consistent that it looked boring from the outside, but it worked like compound interest on steroids. The problem? 99% of traders will never stick to it. Not because the math is hard, but because the discipline it takes to follow it breaks most people long before the money gets big. Welcome to Disciplined Trades, where we rewire your brain so you can trade like the top 1%. In this deep dive, you'll learn the exact risk management and position sizing model that can turn $1,000 into $100,000 and how to bulletproof your psychology so you don't sabotage it halfway. We'll cover the compounding formula the pros quietly use while everyone else chases big wins, the 3 emotional traps that kill compounding before it works, why your growth rate should slow down as your account grows, not speed up, and the mental framework that makes small gains feel exciting enough to keep going for years. By the end, you won't just know the plan, you'll see exactly how to follow it day by day until $100,000 is no longer a dream. It's just math. Before we start, drop in the comments. If I could show you a 100% mathematical path to 100K, but it took 3 years, would you follow it? Your answer says more about your trading future than you think. Chapter 1. The Power of Tiny Gains. Why plus 1% a day beats big wins. Here's a paradox most traders never understand. The fastest way to grow your account is often to not trade at all. Sounds crazy, right? But let me prove it. When new traders dream of hitting 100K, they think more trades equals more opportunities. More screen time equals more control. More action equals more money. Here's the truth. More is usually less. Every trade you take without an edge bleeds your account slowly, like death by 1,000 cuts. The amateur thinks missing a trade is lost money. The pro knows missing a bad trade is saved money, and that saved money compounds like magic. Imagine 2 traders. Trader A takes 200 trades per month, random setups, no patience. Trader B takes 20 trades per month, waits like a sniper. Result after 12 months. Trader A burns his capital death by commissions, slippage, and emotional tilt. Trader B compounds steadily, every trade is high conviction, low stress, high expectancy. The discipline multiplier is simple. 1 avoided bad trade can save you 10 good ones. One student I mentored started with $3,000. Month 1, 140 trades. Account at $2,600. Exhausted. Month 2, forced himself to take max 30 trades. Account stable at $2,950, confidence returning. Month 6, averaging 25 trades per month. Account at $5,200. Month 18, same patience, account over $18,000. His words, my edge wasn't finding more trades. My edge was deleting 90% of them. The formula in practice. Rule number 1, define your A+ setup. If it doesn't match perfectly, skip. Rule number 2, max trades per week. 3 to 5 is enough. Rule number 3, journal skipped trades. Celebrate the ones you avoided just as much as the ones you took. Example, account $5,000. Risk per trade 1% or $50. Target setups 3 per week. Execution only if all criteria align. Put differently, patience is profit. Your brain will scream, but what if I miss it? That's FOMO. Pros reframe it, if I skip, I survive. If I survive, I compound. The psychology that makes it work, detachment from activity. You don't need to be busy to be profitable. Celebrate the skips, write down, didn't trade, protect the capital, that's a win. Sniper identity. You're not a machine gunner spraying bullets. You're a sniper. One shot, one kill. Action step, the no trade drill. For 7 days, sit at your charts. Identify trades. Don't take them. Just write why you would take them. After 7 days, review. Did most setups actually work? Or did you just dodge bullets? You realize something shocking. Most trades weren't worth taking. In trading, discipline is the ultimate leverage. Every trade you don't take is money you didn't lose, and that's the hidden compounding most traders ignore. Your 1,000 to 100,000 journey might not be about finding the next big win, but about deleting the 99 bad ones. In Chapter 2, we'll cover the patience gap, why amateurs crave action, but pros get rich waiting. Chapter 2, the risk size sweet spot, how to grow fast without blowing up. Everyone asks, how much should I risk per trade? But let's be honest, that's not the real question. The real question is, how fast can I grow my account without blowing it up? And that's where 99% of traders kill themselves. They fall into the two deadly extremes. Extreme number 1, too little risk. Risking 0.1% per trade on a small account. Safe? Sure. But growth is so slow, you'll quit before compounding ever kicks in. Extreme number 2, too much risk. Risking 5 to 10% per trade. Feels exciting until one normal losing streak cuts your account in half. Here's the truth. The sweet spot for most traders is boring, somewhere between 0.5% and 2% per trade. Example with $1,000 starting balance, 0.5% risk equals $5 per trade, which translates to low stress, slow growth, but safe. 1% risk equals $10 per trade, which translates to balanced growth and survival. 2% risk equals $20 per trade, which translates to faster growth but wild drawdowns. And losing streaks will come. Even with a good system, at the 1% risk, 5 losses in a row equals minus 5% drawdown. At 5% risk, 5 losses in a row equals minus 23% drawdown. Here's the math kicker. Lose 20% and you will need plus 25% just to break even. Lose 50% and you will need plus 100%. The bigger your risk, the harder the math punishes you. So why do most traders risk too much? Impatience bias. The belief that faster means better. But in reality, overleverage is the number 1 cause of account death. One trader that I trained started with $1,500, risked 3% per trade. Month 1, plus 18% return. Confidence sky high. Month 2, 7 loss streak equating to minus 21% in 1 week. Panic, tilt, revenge trades. End of month, account down 50%. Game over. What if he'd risked 1%? Same streak equals minus 7% drawdown. Annoying, but recoverable. The difference wasn't the system, it was the risk size. Finding your sweet spot. Step 1, know your stats. Win rate and risk to reward. Higher win rates allow slightly more risk. Lower win rates demand smaller risk. Step 2, backtest your pain. What's the longest losing streak in your last 100 trades? Double it. Make sure your chosen risk can survive it. Step 3, match it to your brain. Some traders handle 15% drawdowns calmly. Others panic at 5%. Your sweet spot should feel slightly uncomfortable, but never terrifying. The growth simulation. Trader A risks 1% per trade, wins 55% at 1.5 R average. Trader B risks 2% per trade, same stats. After 200 trades, Trader A equals plus 105% growth, max drawdown around 8%. Trader B equals plus 230% growth, max drawdown around 17%, both profitable. But here's the catch. If Trader B can't stomach the pain, he'll blow up before compounding pays off. That's the paradox. Bigger risk looks like faster growth, but only if your psychology survives. The risk drill. Take your last 50 trades. Simulate them with 0.5%, 1%, 2% risk. Record growth plus max drawdown. Then ask, could I live through that drawdown without breaking my rules? If the answer is no, lower your risk. Advanced edge, dynamic scaling. As your account grows, your numbers get scary. $1,000 at 1% equals $10. $10,000 at 1% equals $100. $50,000 at 1% equals $500. Most traders panic when the 500 loss hits, even though it's the same 1%. Solution: scale down risk percent as the account scales up. Example: $1,000 at 1% risk equals $10. $10,000 at 0.75% equals $75. $50,000 at 0.5% equals $250. Growth slows slightly. Stress drops massively. Survival skyrockets. My final thought for chapter 2 is that the sweet spot isn't about how much you can risk. It's about how much you can risk and still execute flawlessly for years. The traders who survive long enough to see 100,000 aren't the ones who bet big. They're the ones who bet just enough to keep playing the game until the math does its work. In chapter 3, we'll unlock the compounding blueprint, the step-by-step schedule to grow $1,000 into 100,000 with built-in safety buffers for every drawdown. Chapter 3, the compounding blueprint, the step-by-step path to 100K. Most traders talk about compounding like it's magic, but magic is unpredictable. Math isn't. This chapter is the blueprint. Follow it, and the only thing between you and $100,000 is time plus discipline. Why most compounding plans fail? No fixed percent risk. They size positions by confidence, breaking the math, pulling profits too early. Withdrawing gains before the snowball can build speed, chasing daily targets, forcing trades to make the number, turning discipline into gambling. The foundation, fixed percent risk. Compounding only works if risk is a fixed percent of your account. Recommended range, 0.5% to 1.5% per trade. That way, position size grows automatically as your balance grows. Example: $1,000 account at 1% risk equals $10 per trade. A $2,000 account equals $20 per trade. A $10,000 account equals $100 per trade. That scaling is the engine behind exponential growth. The 1K to 100K schedule with 1% per day on average. Year 1, beginning, 1,000. End, roughly 11,700. Year 2, beginning, 11,700. End, roughly 137,000. Even at 0.5% per day, on average. Year 1 equals $2,700. Year 2 equals $7,400. And year 4 equals roughly $101,000. Same math, different speed. The only question, how long can you stick with it? The boredom trap. In the beginning, plus $10 a day feels like nothing. That's why 99% quit. Not because it doesn't work, but because it feels too slow. The pros know the first 6 months are boring. The last 6 months are life-changing. Drawdowns are inevitable. Even the best system loses. That's built into the blueprint. Rule: never increase risk in a drawdown. Optional: cut risk until equity recovers. Example: $5,000 at 1% risk equals $50 per trade. Drop to $4,500 at 0.75%, and this would equal $33.75. Back to $5,000 at 1% again. Simple, safe, keeps you alive, both financially and mentally. Case study: slow, boring, and unstoppable. A trader starts with $3,000, risks 0.8% per trade. Month 6, $4,550. Month 12, $6,800. Month 24, $15,400. Month 36, $34,800. The curve looked flat at first. Then it exploded. Compounding is sneaky like that. Slow, then sudden. The 4 commandments of the blueprint. Number 1, no forced trades. Missing a day is better than forcing a loser. Number 2, no emotional risk changes. Confidence is not a money management strategy. Number 3, monthly review, not daily obsession. Judge success by the month, not by the tick. Number 4, stay in the game. The math only works if you're alive to see it. Action step: build your 100,000K sheet. Open your Excel sheet. Column A, day 1, 500. Column B, balance starting at $1,000. Formula: balance times 1.01 each row. Highlight milestones like double, 10K, 50K, or 100K. This sheet is your visual proof. When you see the curve, you start respecting the curve. Scaling into real freedom. At $50,000 account size, 1% average per day equals $500 a day. Option A, keep compounding. Option B, withdraw a slice monthly, for example 2,500, and still grow the balance. This is how pros turn compounding into freedom, not just numbers on a screen. My final thought for chapter 3 is that this blueprint isn't exciting in the short term, and that's exactly why it works. It's built for traders willing to delay excitement for long-term certainty. In chapter 4, we'll tackle the psychology of delayed gratification, the mental rewiring that keeps you from chasing fast thrills and blowing up before the finish line. Chapter 4, the psychology of delayed gratification. Why boring wins big. The market will test you in 100 ways. But the hardest test isn't a losing streak. It's the months where everything works, just not fast enough. The hidden killer of compounding isn't losses. It isn't strategy flaws. It's impatience. The first stage of the $1,000 to $100,000 plan feels slow. You are following the blueprint, winning more than losing. And still, your account is growing in what looks like tiny steps. Your brain wants to skip to the good part, the $500 days, the $1,000 weeks. But in trading, skipping ahead usually means blowing up. Psychologists call it temporal discounting, the tendency to value immediate rewards far more than larger future rewards. In trading, this bias makes plus $20 today feel meaningless compared to a dream of $2,000 later. The problem is, without the small plus $20 days stacking, the $2,000 days never arrive. One trader followed the 1% per day plan for 3 months. Account grew from $1,000 to $1,350. Decided progress was too slow. Double risk to 4% per trade. Hit a normal 5-loss streak. Account dropped to $1,100. Quit the plan in frustration. If they had stayed the course, that $1,350 could have been $10K in under 2 years. The marshmallow test for traders. In the famous Stanford marshmallow experiment, children could choose 1 marshmallow now or 2 if they waited. The kids who waited had better outcomes in life decades later. Trading has the same test, except the wait period can be years. The ones who pass it are the ones who let compounding do its job without interference. This is how to train patience in the market. Zoom out your tracking. Look at monthly or quarterly percent growth, not daily dollar amounts. Example, I'm up 8% this month feels better than I made $8 today. Gamify milestones, celebrate percentage milestones, plus 25%, plus 50%, account doubled. This keeps motivation high without changing your risk plan. Practice with delays outside trading. Build patience in other areas. Workout programs, learning a skill, saving money. Patience is a muscle train at everywhere. Most traders fail the 1K to 100K challenge, not because it's too hard, but because it's too boring. This is actually a feature, not a bug. If it were exciting, more people would do it, and fewer would survive. The boredom phase filters out the gamblers and leaves the builders. Instead of rewarding yourself for big wins, reward yourself for sticking to the plan. Example, every 3 months of 100% plan adherence, treat yourself, either with a nice experience, small gift, or something else. This reinforces discipline without relying on random big trades. Action step, create your why card. Write down why you're willing to wait years for the 100K. What you'll do when you get there. One sentence reminding you that every boring day is a brick in the wall. Keep it where you trade, read it on slow days. My final thought for chapter 4 is, if you can't master delayed gratification, no compounding plan will work, because you'll quit before the math starts paying you. The 1,000 to 100,000 plan rewards the patient, punishes the restless, and ignores everyone in between. In chapter 5, we'll cover the rule of 100 trades, why your first real measure of success shouldn't come until you've placed and logged your first 100 disciplined trades. Chapter 5. The Rule of 100 Trades. Stop judging yourself too soon. If you're evaluating your performance after 5, 10, or even 20 trades, you're not analyzing, you're guessing. The market doesn't reveal the truth until you've put in the reps. But why is 100 trades the first real milestone? Trading results are noisy. You can win 8 out of 10 trades and still be on a losing path if they were all lucky entries. You can lose 6 out of 10 trades and still be a future 100K trader if your winners are bigger than your losers. Only after a large enough sample size, roughly 100 trades, can you get a statistically meaningful view of your true edge. The problem with early judgments is simple. 1. Small sample variance. In small sizes, luck dominates skill. 2. Emotional overreaction. Judging too early leads to system hopping after normal losing streaks. 3. Incomplete data. You don't yet know your average win, loss, or drawdown profile. The 100K trade framework. Step 1. Fixed rules for the sample. No strategy changes mid-sample. No emotional position sizing. Step 2. Detailed tracking. Log entry and exit screenshots. Log the reason for entry. Log risk in percent. Log the R multiple outcome like +1R, -0.5R, etc. Log your emotional state before and after the trade. Step 3. End of sample analysis. After 100 trades, calculate win rate, average R multiple, expectancy equals win percent times average win, minus loss percent times average loss, longest win streak, and losing streak. Case study, the misleading month. One trader had a plus 15% month after just 18 trades. They felt invincible, increased risk from 1% to 3% per trade. The next month's losing streak erased all gains and more. When we ran their first 100 trades in simulation, their expectancy was just slightly above 0. That early win streak was pure variance, not skill. Why the rule of 100 protects you. It forces you to separate performance evaluation from emotional reaction. Instead of asking, am I making money? After 10 trades, you ask, am I following my plan for 100 trades? The first question is short-term. The second question builds careers. The math behind it. If your strategy has a true expectancy of plus 0.3 R per trade and you risk 1% per trade, then in 10 trades, variance could easily swing your results between -5% and plus 8%. In the 100 trades, variance smooth out and you'll be much closer to plus 30% net growth. This is why most professional traders think in batches of trades, not days or weeks. The psychology bonus. Committing to 100 trades at fixed risk builds emotional detachment. Each trade becomes one of 100 instead of the trade that has to work. When the outcome of a single trade matters less, you execute better. Action step. Your first 100 trade challenge. Pick one strategy per setup to test. Lock in your risk percent for the entire 100 trades. Commit to 0 rule changes until the sample is complete. Log everything screenshots, notes, emotions. When you hit trade number 100, the data will tell you whether to scale, refine, or discard. Advanced edge, rolling 100 view. Once you've done your first 100, never stop. Always track your most recent 100 trades. This keeps your performance assessment current without overreacting to short-term swings. Example, if trades 1 to 100 show plus 25%, but trades 50 to 150 show only plus 5%, you know something's slipping in execution or market conditions. Case study, the quiet builder. A trader started with $1,200 and a scalping strategy. Completed 100 trades in 2 months, plus 9% gain. Completed next 100 trades, plus 11% gain. Confidence rose, but risk stayed constant. After 500 trades, they had grown to $2,200, slow by gambler standards, but steady and compounding. By year 3, they were over $25,000. Final thought for chapter 5. The rule of 100 isn't just about getting better data. It's about breaking the habit of judging yourself too early. Small samples lie. Big samples tell the truth. If you want 100K, stop asking if it's working after 10 trades. Prove it over 100. In chapter 6, we'll cover the emotional stop loss, the mental limit that saves you from blowing up on bad days before your risk plan can save you. Chapter 6. The emotional stop loss. protecting yourself when logic fails. Most traders set a price stop loss. The pros set a psychological stop loss too, because sometimes the biggest danger isn't the chart, it's you. Why a price stop isn't enough. Your chart stop protects you from one bad trade. Your emotional stop protects you from the day you go off the rails. Without it, a bad morning can turn to a blown account by the afternoon, not because your system failed, but because you did. The psychology of tilt. Tilt is what happens when frustration, fear, or overconfidence hijacks your decision making. You double size after a loss to win it back. You skip your setup criteria because this one feels right. You keep trading well past your normal hours trying to force a green day. This is loss of state awareness. You stop noticing you are no longer trading your plan. Case study. The afternoon blow up. A trader started the day down -2%. Ignore their own max loss rule. Overtraded until the account was down -14% by the close. Needed +16% just to break even. The emotional stop loss would have shut them down after the -2% hit, saving them weeks of recovery. How to set your emotional stop loss. Rule number 1, daily max loss. Choose a percent or dollar amount that, if hit, ends your trading day, no matter what. Common, 2 to 3% of account equity. Rule number 2, max loss in trades. Example, stop after 3 consecutive losing trades, even if total loss is small. Rule number 3, tilt signals checklist. Rushing entries, skipping analysis, feeling angry or desperate means time to walk away. Why it works. The emotional stop loss interrupts the emotional momentum that fuels revenge trading. Once your emotions spike, logic takes a backseat. A hard stop forces you out before the damage is irreversible. Some traders think they're strong enough to push past tilt without a stop. The problem? Tilt doesn't announce itself politely. By the time you notice, it's too late. The pros assume they're human. That's why they have rules that save them from themselves. At the prop desk I worked with, every trader had a locked-in daily max loss. Hitting it automatically froze their platform until the next session. The firm found it reduced average monthly drawdowns by over 40%. Action step. Build your emotional stop plan. Pick a daily max loss percent and trade limit. Step 2. Define 3 personal tilt triggers, such as ignoring stops, chasing entries, oversizing, etc. Step 3. Write them on a sticky note near your screen. If 2 of the 3 happen, you stop trading. When you hit your emotional stop loss, physically leave your desk. Do a 10 to 15 minute non-trading activity. Walk, exercise, meditate. Then review your trade journal without placing another trade. Over time, you will train your brain to see stopping as a win, not a loss. Without an emotional stop loss, the math we've been building can be destroyed in a single session. The market will always be there tomorrow, but only if you protect your capital and your mindset today. Final thought for Chapter 6. Your emotional stop loss is like the circuit breaker in your house. You don't install it because you plan to blow the fuse every day. You install it because one surge without protection can burn the whole place down. In Chapter 7, we'll look at scaling the right way, how to increase position size as your account grows without letting greed and fear sabotage the curve. Chapter 7. Scaling the right way. Growing size without growing stress. Most traders dream about trading bigger, but size is like fire. It can warm your house or burn it to the ground depending on how you handle it. When people picture scaling, they imagine this. Start small, double position size every month, end up trading massive loss in record time. In reality, that's the fastest route to blowing up. If your size grows faster than your emotional capacity, your psychology will sabotage you. The principle of natural scaling. In the 1K to 100K plan, scaling happens automatically. Risk stays the same percent, for example 1%. As account equity grows, so does position size. Example, $1,000 at 1% risk equals $10 per trade. $5,000 at 1% risk equals $50 per trade. $25,000 at 1% risk equals $250 per trade. This slow, automatic scaling keeps emotional pressure manageable because growth is gradual. The danger of forced scaling. Jumping from $10 risk to $50 overnight feels exciting until you realize every tick now means more dollars. Your brain reacts differently to the same setups when more money is at stake. This often leads to hesitation on winners and panic access on losers, killing your edge. Case study: the $50 leap. A trader grew from $1,000 to $1,500 and decided a $10 risk was too small. Increased to $50 risk per trade, or 3.3%. The first two losses cost -100, which felt huge. Hesitated on next trades, cutting winners early. Win rate dropped, equity curve stalled. When they returned to $15 risk, consistency came back. To avoid emotional overload, increase position size only when your account grows by at least 25% and you've traded at least 50 trades at the previous size with full rule adherence. Example, from $1,000 to $1,250 equals an increase from $10 risk to $12.50. From $5,000 to $6,250 equals an increase from $50 to $6,250. This makes scaling a gradual, earned process, not an impulsive one. Every time your risk amount increases, you need a few weeks to get comfortable. During this time, expect minor hesitation and overthinking. Focus even harder on process, not P&L. Think only in R multiples. When you hit a new equity milestone, trade 50% of positions at the new size. Trade 50% at the old size. After 2 to 3 weeks, transition fully to the new size. This eases the emotional jump and keeps execution sharp. Action step: build your scaling roadmap. Decide your base risk percent, for example, 0.5 to 1.5%. Set scaling milestones every plus 25% in account growth. Commit to trading 50 to 100 trades at each level before moving up. Two students of mine started at $2,000, both risking 1%. Trader A double-sized every time they felt ready. Trader B followed the 25% rule. After 18 months, Trader A account back at $2,000 after multiple blowups. Trader B account at $6,200. Win rate stable. Stress low. Final thought for Chapter 7. Scaling's not about getting rich faster. It's about letting your equity growth pull you forward at a pace your mind can handle. The market will give you opportunities forever, but only if you don't burn out before the compounding curve bends in your favor. In Chapter 8, we'll cover the plateau phase, why your growth will sometimes stall, and how to break through without forcing bad trades. Chapter 8, the plateau phase, when growth stalls and patience gets tested. Every trader loves the uptrend in their equity curve until it flattens. The plateau phase isn't a sign you're failing. It's a sign you're human and you're in the middle of the journey. Why plateaus happen? Even with a solid strategy, growth is never a perfect upward line. Plateaus occur for three main reasons. Market conditions shift your setup still work, but they appear less often. Variance in results, normal clustering of wins and losses creates break-even stretches. Psychological drag hesitation or overcaution after a loss streak reduces profitability without you noticing. Case study: the 6-week flat line. A trader grew from 1,000 to 1,350 in 3 months following the plan. Then 6 weeks of plus 1% versus minus 1% days. Account stuck between 1,000 to 1,340 and 1,000 to 1,360. Frustration led them to take a bonus trade outside their rules. One bad entry cost minus 4%, extending the plateau another month. The danger of plateau impatience? Plateaus are the breeding ground for system hopping and risk inflation. If you can't tolerate slow or sideways periods, you'll break the plan right before the next growth surge. Compounding is exponential, but the early stages feel linear. Most of the explosive growth happens late in the curve, after enough small wins have stacked. The plateau phase is the toll booth before the highway speeds up. If you want to break through without forcing trades, double down on data review, confirm you are still following rules. Hunt for leaks like late entries or early exits. Increase selectivity fewer, higher quality trades often break plateaus faster than overtrading. Micro optimization, small, back-tested tweaks to timing or stops can tilt expectancy slightly in your favor. If you want a parallel growth streams during a plateau, add a secondary, complementary setup to your playbook, but only after testing. Example, primary equals trend following setup on EURUSD. Secondary equals mean reversion setup on gold. More opportunity without forcing bad trades. The psychological strategy for the plateau is to reframe time. Think in terms of next 500 trades, not next 5. Celebrate process wins. Reward yourself for perfect plan adherence, even if the account balance is flat. Keep a plateau journal, log boredom, frustration, temptations. Those notes become gold the next time you hit a flat patch. Case study, the patient breakthrough. A trader plateaued at $4,800 for 2 months. Stayed strict, didn't chase. In month 3, market conditions shifted. 5 weeks later, balance was $5,900, a plus 23% jump. That never would have come if they bailed mid-plateau. Before changing your system, ask, have you logged at least 100 trades in the plateau? Is expectancy still positive? Have market conditions actually changed? Or is this just variance? Only adjust when the data says so, not your emotions. My final thought for Chapter 8 is that the plateau phase tests discipline harder than losses, because boredom tempts you to break the plan. If you can keep executing here, you'll be ready for the acceleration that always follows. In Chapter 9, we'll tackle the withdrawal trap, why pulling profits too early can cripple your curve, and how to withdraw the smart way. Chapter 9, the withdrawal trap, how to take profits without killing the curve. You're growing your account, finally seeing the curve bend upward, and then you pull money out. Done wrong, that single decision can set your 100K goal back months or even years. Why early withdrawals hurt more than you think? The compounding engine only works if your full equity is in the game. Hold money too soon and position size shrinks. Growth slows just when the curve is about to accelerate. Example, account at $5,000, risk 1% equals $50 per trade. Withdraw $1,000, account drops to $4,000, risk now $40 per trade. You just reduced your engine by 20%. The emotional triggers behind the trap. Impatience wanting to enjoy gains before they matter. Fear believing cashing out locks it in. Lifestyle creep raising expenses the moment trading starts to work. All three sabotage the curve long before it gets powerful. One of mine traders grew 1,000 to 3,200 in under a year. Starts pulling 100 monthly for small expenses. Growth rate drops from 9% per month to 3%. Took another 18 months just to reach 5,000. Withdrawals cut the compounding curve in half. When you shouldn't withdraw, not before your account is at least 5 to 10x your start size. Not during drawdowns. That removes recovery capital. Not in the steepest part of the growth curve. The smart withdrawal strategy. Phase 1. Accumulation. No withdrawals until equity hits a milestone where position size covers lifestyle needs without killing growth. Target. 50K to 100K before steady withdrawals. Phase 2. Partial harvesting. Withdraw a fixed percent of profits, not of balance. Example, take 20% out, leave 80% compounding. Phase 3. Hybrid approach. Keep a core capital untouched. Withdraw the excess quarterly. The math of delayed gratification. Scenario A. Withdraw early. $1,000 at 6% per month for 12 months equals $2,012. Start pulling $100 per month and balance stalls near $2,000. Scenario B. Delay withdrawals. $1,000 at 6% per month for 24 months equals to $4,035. Start withdrawals only after doubling core capital and growth continues while you still get paid. If you crave rewards early, siphon small fixed amounts into a second account for fun or testing. Keep your main account untouched. You get the hit of enjoying profits without sabotaging the compounding engine. Your action step should be that you commit your withdrawal policy. Write down your equity milestone before the first withdrawal. Decide your percent of profit to withdraw once it's hit. Lock yourself into quarterly withdrawals to kill emotional temptation. Case study. The delayed reward winner. Started at $2,000, no withdrawals for 3 years. Year 1, $3,600. Year 2, $7,800. Year 3, $16,200. Then they began pulling $500 per month while the account kept growing. Withdrawals became free money instead of lost momentum. My final thought for Chapter 9 is that the market rewards patience twice. First, with an accelerating account curve, then with the freedom to pull money without slowing it down. Withdraw too early and you stall the vehicle. Withdraw smart and you get paid for life. In Chapter 10, we'll cover the 80-20 of trade selection, how 20% of your setups drive 80% of your profits, and how to double down on them. Chapter 10, the 80-20 of trade selection, focus on what actually pays you. Not all trades are created equal. Most of your growth won't come from every entry you take. It will come from the handful of setups that truly pay. The rest, noise. Sometimes worse than noise, they're the leaks that drain your account. This is the 80-20 principle in action. In trading, 80% of your profits almost always come from 20% of your trades. But most traders ignore it. They chase everything, thinking more trades means more opportunity. In reality, it means more mediocrity. One trader proved it the hard way. They logged 300 trades in a year. Setup A delivered nearly 50% growth. Setup B barely moved the needle. Setup C lost money. When they finally cut the dead weight and focused only on setup A, their next year's results doubled. Fewer trades, more growth. That's the loop you want to create. The more you focus on what works, the sharper your execution becomes. Confidence rises, hesitation fades. The screen stops feeling like chaos and starts feeling like a hunting ground because you know exactly what you're hunting. And here's the trick. You don't need to trade bigger across everything. You scale only inside the winners. Keep base risk at 1%. On your best setups, allow 1.5%. On test setups, cut to 0.5%. You're not trading more, you're allocating smarter. This focus doesn't just grow your account, it clears your head. Less decision fatigue, less emotional noise, easier tracking. You can spot instantly when something slips because you're only measuring what matters. Final thought. The market will always throw endless setups at you. But freedom doesn't come from chasing everything. It comes from doubling down on the few patterns that actually pay and letting compounding do the rest. Chapter 11. The Mental Recovery Day. Resting like a pro trader. The markets never close. Your mind should. If you think grinding 7 days a week will get you to 100K faster, it's more likely to burn you out before you get halfway. The illusion of endless hustle. Many traders believe more screen time equals more success, or taking a day off is falling behind. But your trading results don't come from time in the chair. They come from quality of execution. And quality collapses without recovery. Why you need a mental recovery day. Decision fatigue. Trading is high-intensity decision-making. Without rest, your accuracy drops. Emotional overload. Even winning streaks create stress. Over time, that stress erodes discipline. Pattern blindness. Staring at charts too long dulls your ability to see clean setups. The 90-day burnout. A trader went 90 days without a single day off. Started making emotional trades in week 10, ignored journal reviews in week 12. By week 13, they had wiped out 30% of their gains. When we added one weekly rest day, their win rate recovered without reducing long-term profit. What a true recovery day looks like. It's not just no trading. It's active mental recovery. No market charts or news. Unplug completely. Physical reset, exercise, walk, stretch. Social reset. Spend time with friends and family. Mental reset. Hobbies, reading, creative activities. The science of recovery. Sports psychology calls it the super compensation effect. After intense effort, rest allows performance to rebound stronger than before. Trading is no different. Without recovery, you plateau or decline. Advanced edge, pre-planned recovery calendar. Don't wait until you are burnt out to rest, schedule it in advance. Example, one fixed rest day per week, one longer break every 8 to 12 weeks, 3 to 5 days off. Your brain trades better when it expects rest periods. How recovery improves the 1K to 100K plan. Fewer revenge trades. Rest days reset emotional balance. Sharper entry selection. A rested brain spots high-quality setups faster. More consistent execution. No mental drag from constant chart watching. Case study, the weekend rule. One trader committed to never trading Saturday or Sunday. Even in crypto markets, found they made fewer impulsive trades on Monday. Win rate improved by 8% over 6 months and reported feeling more excited to trade after breaks. Action step. Design your recovery protocol. Step 1. Pick a fixed day weekly for zero market exposure. Step 2. Choose 2 to 3 non-trading activities you'll always do on that day. Step 3. Add quarterly extended breaks to your calendar. Mindset shift. Stop seeing rest as time lost. See it as an investment in execution quality, the same way an athlete sees recovery as part of training. Final thought for Chapter 11. Trading is a performance sport for your brain. Without recovery days, you're not hustling. You're grinding yourself into mediocrity. In Chapter 12, we'll dive into the drawdown bounce back plan, the step-by-step method to recover from losing streaks without derailing your journey to 100K. Chapter 12, the drawdown bounce back plan, recovering without self-destructing. The markets will test you, not just with winning streaks, but with losing streaks that feel like quicksand. Every trader hits drawdowns. The difference between amateurs and pros isn't avoiding them, it's surviving them. Here's the truth. A losing streak doesn't end accounts. Overreaction does. Tilt does. The spiral does. The danger isn't the loss itself, it's what you do next. Add size to win it back. Take setups that don't fit your plan. Trade longer hours, trying to force a recovery. That's how a normal 5% drawdown becomes a blown account. The pros, they have a bounce back plan before the pain hits. Rule 1. Cut risk, not discipline. When you're down, you don't double up, you cut down. If you normally risk 1% per trade, drop to 0.5%. Keep playing but with lighter pressure. This slows the bleeding, buys time, and gives your brain the space to reset. Rule 2. Review without emotion. Drawdowns feel personal, but they're just math. Was it market conditions? Was it variance? Or was it execution? You won't know if you're judging from frustration. That's why pros review journals, not emotions. Rule 3. Stay in the game. A 10% drawdown feels huge, but with patience, it's recoverable. Blow up? That's unrecoverable. Your only real edge is staying alive long enough for the curve to bend back in your favor. Case study, the calm survivor. One trader lost 10% in a brutal week. Instead of chasing, they cut risk in half, logged everything, waited. Within a month, their account had recovered. 3 months later, they were at new highs. Their edge didn't change. Their mindset did. The recovery drill, your action stat. Write down your max drawdown tolerance. Define your risk cut level. At what percent you have position size. Build a review ritual. Journal every trade, then recheck after 20 trades. Decide the rules that get you out of the chair if tilt kicks in. This way, you never have to guess in the heat of the moment. The system protects you from yourself. Final thought for Chapter 12. Drawdowns don't just test your system. They test your patience, your discipline, your identity as a trader. Most blow up not because they can't win, but because they can't sit still while losing. The traders who survive, they don't avoid pain. They respect it. They shrink size, breathe, review, and come back sharper. The market will always test you. But if you build your bounce back plan, you'll always have an answer. In Chapter 13, we'll dive into the discipline flywheel, how tiny habits compound into unstoppable momentum. Chapter 13, the end of month reset, locking in lessons, not just profits. Most traders close the month, glance at the P&L, and move on. Pros close the month, dissect it, and upgrade their edge for the next one. Because if you only zoom in on single trades, you miss the bigger pattern, and trading is a game of patterns. Daily reviews keep you sharp on execution, but daily data is too noisy to reveal the truth. A month of trades, though, that's where the story shows itself. Which setups keep paying you, which mistakes keep draining you, and whether your risk-reward ratios are still intact. 1 month is enough to see trends and short enough to fix them before they cost you a year. That's why pros use a monthly reset. 3 parts, always the same. First, the performance audit. How many trades did you take? What's your win rate? What's your average R multiple? How big was your best streak and your worst? Then ask yourself the killer question. If I repeat this exact month 12 times, where will I be in a year? Second, mistake analysis. This is where the truth stings. How many trades broke your own rules? What emotion drove them? FOMO, revenge, boredom? And how much did that cost you in percent equity? Most traders don't like looking here. That's why most stay stuck. Third, edge refinement. Find the 20% of setups that carried you. Cut the bottom 20% that bled you. And if the market itself shifted, adapt your watch list. Not with 10 changes at once, just one clear tweak. Because upgrading too much too fast isn't refinement. It's chaos. One trader closed a month at plus 12%. Looked solid, but their review showed 5 off-plan trades cost minus 6%. The profits came from 2 clean setups they'd been trading for months. If they just cut the noise, they have finished at plus 18%. Same effort, more discipline. And here's the hidden benefit. Monthly resets clear your psychology. You don't carry last month's frustration into this one. You don't ride last month's euphoria into overconfidence. Every new month starts clean, not hot, not cold, just a trader executing the plan. That's the secret of the monthly reset. It turns scattered weeks into one coherent journey. It forces you to stop, reflect, and evolve. And the 1K to 100K plan is built on exactly that. Not perfection, but consistent upgrades. In Chapter 14, we'll open up the confidence bank, how to build mental capital so you can trade fearlessly without slipping into recklessness. Chapter 14, the confidence bank, building mental capital without becoming reckless. Your account balance isn't the only capital you trade with. Your confidence is a hidden account, and if you overdraft it, you will either stop taking good trades or start taking terrible ones. Think of confidence as mental capital. Every time you follow your plan, every time you execute without hesitation, every time you let a trade play out by the rules, that's a deposit. Every time you hesitate, break your own rules, or hit a string of losses without review, that's a withdrawal. Run the account low and fear takes over, overfill it recklessly, and overconfidence takes over. This matters because in the 1K to 100K plan, confidence is the fuel behind every decision. Too little confidence, and you undertrade, skip your edge, and slow the compounding curve. Too much confidence, and you oversize, force trades, and damage the curve. Both kill progress. One trader had 8 winning trades in a row. Confidence spiked. They doubled risk size. The next 3 trades lost, and half the month's gains were gone. The problem wasn't the system. It was overspending from the confidence bank. So how do you grow this account without blowing it? By making deposits. Following your plan, even on losing trades, builds trust in yourself. Rewarding perfect execution, not just P&L, makes wins sustainable. Scaling gradually keeps confidence stable, and just like money, you need to protect it from overdrafts. Never skip a post-trade review losses, drink faster when they're not understood. After a big win streak, schedule a cooldown day with smaller size. And always thinking R multiples, not raw money, so you normalize results and avoid emotional inflation. Want an advanced edge? Track confidence as if it were a bank balance. Start each week at 100 units. Add +5 for sticking to your plan. Subtract -10 for a major rule break. If your balance drops under 60, cut size until you rebuild. When it climbs above 80 and hold, only then do you earn the right to scale. Because confidence and equity are linked in a loop, your mental state drives execution. Execution shapes outcomes. Outcomes feed back into your confidence. Manage it well, and the loop spirals upward. Ignore it, and the loop drags you down. One trader kept a simple rule. Never increase size unless their confidence ledger was above 80 for 2 straight weeks. That one habit prevented emotional scaling. and their curve grew steadier, smoother, and stronger. So build your own confidence bank plan. Define what earns deposit, define what drains it. Track it weekly. Reduce size when confidence drops below 70, only scale up when you're above 85. Final thought for chapter 14. Confidence is the silent fuel of your 100K journey. Protect it like capital. Grow it like capital. Spend it wisely. In chapter 15, we'll cover the one market mastery rule, why focusing on a single market or pair early on can double your learning speed and your growth rate. Chapter 15, the one market mastery rule. Learn deep before you trade wide. The fastest way to slow your growth? Spread your attention across every market you can click on. The fastest way to speed it up? Master one market before touching another. Every market has its own personality, its own traps, volatility, news behavior, time of day patterns. Some spike violently, some grind quietly, some only wake up for one session. Focus on one, and you internalize these rhythms faster than anyone else, because trading is pattern recognition. If you split attention, you get surface level knowledge of many markets. If you focus, you get deep familiarity with one. That depth is where the edge is. One trader started with 1,000, 18 months trading only Euro USD, learned how it reacts to ECB news, learned session opens, learned the fake levels that trap the crowd. After 2 setups became rock solid, only then did they add GBP USD. Result? Both pairs paid because mastery transferred. Every market you add increases cognitive load. Different spreads, different stop distances, different fakeouts, different rhythms. Your brain has limited decision-making energy per day. Blow it on scanning 10 charts and you have nothing left for execution. Focus preserves it. So when are you ready to expand? Not in the first 50 trades, not in the first 100 losses. You expand when you've logged 100 plus trades in your primary market with positive expectancy. When you can spot an A+ setup without notes. When your emotional reactions are stable no matter the outcome. Advanced Edge? The one market journal. Keep notes only for your chosen market. Pre-market bias. Odd behaviors. Screenshots of clean setups, even the ones you didn't take. Over time, this becomes a personal playbook. You will see moves before they happen, not because you are psychic, but because you've lived inside that market's rhythm. The connection to 1K to 100K is simple. Compounding needs consistency. If you switch markets daily, you reset your learning curve daily. Mastery compounds just like money slow at first, then explosive later. 2 traders started with $2,000. The hopper chased 12 pairs and 5 indices. Ended the year at 2,200. The specialist locked on NASDAQ futures. Fewer trades, more precision. Ended the year at 4,900. Same starting point, different focus, different outcome. So pick your market. Commit for 6 to 12 months. Journal every setup, every day, even the ones you skip. This is how you compress learning curves. This is how you accelerate compounding. Final thought for chapter 15. Mastery beats variety, every time. Go deep first, then go wide. Your first 100K will come faster from dominating one market than from dabbling in 10. In chapter 16, we'll cover the micro milestone method. How breaking the 100K goal into small, measurable steps keeps motivation and discipline high. Chapter 16, the micro milestone method, turning a big goal into a winning streak. $100,000 sounds inspiring and intimidating. The secret to making it achievable? Stop chasing the mountain. Start stacking small hills. Here's the problem with big goals. The brain hates waiting. If all you think about is 100K, you'll feel stuck in slow months. You'll force trades to speed things up. You'll lose patience in plateaus. Not because a plan doesn't work, but because the reward feels too far away. That's why we use micro milestones. Not $1,000 to $100,000 in one leap, but $1,000 to $1,500 to $2,000 to eventually $2,500. Little steps, regular wins, a rhythm your brain can lock onto. One trader started with $2,000, broke progress into plus 5% blocks. 2,100 to 2,205, 2,315, etc. Each time, they celebrated. Each time, confidence grew. After 13 months, account was 5,000. No burnout, no rushing, just stacking steps. That's the psychology. Reduced pressure. Instead of thinking, I need $98,000 more, you think, I need $120. Always know the next step, not just the end goal. So how do you set milestones? First, decide your unit of progress, dollar gain, percent gain, or trades executed. Second, keep them small, 3 to 10% increments work best. Third, track them visually. Spreadsheet, journal, progress bar, whatever, keeps it real and visible. Here's the edge. As your account grows, milestones stay the same in percent, but the dollars multiply. $1,000 to $1,050 feels tiny. $10,000 to $10,500 is the same 5%, but now $500. Same skill, bigger payoff. That's the compounding effect of milestones. They also protect your risk. Because when you think in small, near-term steps, you're less tempted to oversize to make a leap. You see growth as controlled steps, not as gambling swings. Another trader used $100 blocks. Every $100 gain was a milestone. They marked each on their journal. Watching that bar fill kept discipline sharp. Over 2 years, they went from $1,000 to $9,200. No blow-ups, no burnout. Just stacking blocks. Action step. Build your micro milestone map. Pick starting equity and target. Break it into 3 to 10% increments. Create a tracker and celebrate each win. Small reward, small break. Teach your brain to love the process. The $1,000 to $100,000 plan works because micro milestones keep you alive long enough for compounding to kick in. The journey stops feeling like someday. It becomes step by step. Final thought for chapter 16. Small wins stack into big wins. If 100K feels impossible today, stop looking at the mountain. Look at the next hill. Climb enough hills, and one day you'll realize you're already standing on the peak. In chapter 17, we'll cover the no trade day discipline, why knowing when not to trade is one of the most profitable skills in your arsenal. Chapter 17, the no trade day discipline, profiting from doing nothing. Some of your most profitable days will be the ones you don't take a single trade. Why? Because capital saved is capital compounded. Here's the trap. Most traders think profits come from more trades, but a huge chunk of losses and emotional damage happens on days when there was no clear edge. Skip those days and you preserve capital for the A+ setups, reduce emotional drawdowns, and keep your mind sharp for the rest of the week. Example, 3 winning days at plus 1% each equals plus 3%, then 1 boredom day at minus 2% wipes out 2/3 of your gains. That's not bad luck, that's bad discipline. Case study, the Tuesday trap. One trader noticed 70% of their losses happened on Tuesdays. The market was quieter, more choppy, less clean. They cut Tuesdays completely. Result, plus 14% more profit that year. So how do you spot no trade days? Easy. No clear A+ setup. Low volatility, where spreads eat your gains. High-risk news events that can spike unpredictably. Or simply, you're off tired, stressed, distracted. Advanced edge, the pre-market filter. Before each session, scan your market. Rate conditions 1 to 10. Only trade if it's at least a 7. This one step kills impulse trades before they happen. The real challenge? Sitting out feels like missing opportunity. But the truth is, no trade days are profitable decisions. The P and L just doesn't show them. Here's how to use them. Deep review of past trades, backtesting, updating watch lists, setting alerts, or stepping away completely workout, reset, recharge. Case study, the month of patience. A trader only allowed A+ setups for 30 days, 40% fewer trades. Win rate jumped from 48% to 62%. Monthly profit up 27%. Less effort, more edge. Action step. Build your no trade rules. Define your filters. Decide your minimum quality score and log every no trade day with the reason. Proof that doing nothing is still part of the plan. Here's the 1K to 100K connection. Every dollar you don't lose on a bad day compounds into more size on a good day. Cutting out the wrong days accelerates your curve without extra risk. Final thought for Chapter 17. Trading isn't just about finding the right trades. It's about avoiding the wrong ones. The discipline to sit on your hands is often the difference between a 50K account and a 100K account. In Chapter 18, we'll cover the pre-trade checklist ritual, the simple 60-second routine that prevents 80% of common mistakes. Chapter 18, the pre-trade checklist ritual, 60 seconds that save thousands. Most blown trades aren't the market's fault. They're your fault for entering unprepared. And here's the good news. A simple 60-second checklist can prevent 80% of costly mistakes. Think about it. In aviation, in surgery, in nuclear plants, checklists are non-negotiable. Why? Because memory fails under stress. And trading is no different. Every trade is high stakes. Without a checklist, here's what happens. You forget to confirm conditions, you skip double-checking size, you enter during a news spike without realizing. One small oversight at a time until your equity leaks out drop by drop. Here's the fix. The 60-second pre-trade checklist. Market conditions, trending, ranging, or chop. Does it fit my playbook? Setup quality. Is this my A+ pattern? Can I define entry, stop, and target clearly? Risk control. Is size locked at 1% or my chosen percent? Am I lowering risk if conditions are shaky? News check. Any red flag announcement in the next 30 to 60 minutes. Emotional state. Am I calm, focused, zero FOMO? Would I take this trading demo without hesitation? If any answer is no, you pass. Period. Case study. The checklist turnaround. A trader averaged 12 trades a week with scattered results. After adding the checklist, trades dropped to 8. Win rate jumped from 46% to 64%. Monthly profit improved. No new strategy needed. Just fewer bad trades. The psychology behind it? A checklist slows you down. Forces logic over impulse. Builds a ritual that makes consistency automatic. Advanced edge. Automation. Program your platform with a pop-up checklist before every order. No boxes ticked, no trade. That pause is what saves your capital. And if you're thinking, it slows me down, if a setup can't survive 60 seconds of scrutiny, it's not worth your money. Or, I already know this. Pilots know how to fly too. They still use a checklist. Action step. Build your personal version. Start with these 5 pillars. Add 1 to 2 questions specific to your setups. Print it, stick it where you trade. Here's the 1 to 100K connection. When every trade is filtered through a checklist, the random leaks vanish. Your equity curve smooths. Compounding finally gets to run without interruption. Final thought for Chapter 18. The most profitable minute of your day isn't after you click buy. It's the 60 seconds before. Checklist discipline turns chaos into consistency, and consistency turns 1K to 100K dollars. In Chapter 19, we'll cover the end-of-day shutdown routine, the ritual that clears your head, locks in lessons, and primes you for tomorrow's trades. Chapter 19, the end-of-day shutdown routine, how to win tomorrow before you sleep tonight. Most traders close their platform and walk away. The pros close their mental loop so they sleep clear and wake up sharp. Why does the end of the day matter so much? Because the last 30 minutes set the tone for the next session. Skip it and you carry baggage, regret, frustration, even overconfidence straight into tomorrow. That's how one bad day turns into 2. The shutdown routine has 3 goals. Lock in lessons so mistakes don't repeat, clear the mind so emotions don't linger, and prepare for tomorrow so you start with a plan, not a scramble. Here's the Discipline Trades end-of-day ritual. Step 1. Trade review. Spend 10 to 15 minutes logging trades. Write the setup, the reason for entry, your execution score from 1 to 10, and the result in R multiples. Ask yourself, was the loss bad luck or bad process? Step 2. Pattern recognition. Spend 5 to 10 minutes spotting repeats. Did you see the same mistake twice? The same winning condition again? Tag those charts. Step 3. Emotional reset. Take 5 to 10 minutes to unload. Write a short paragraph. What went well? What frustrated you? What you focus on tomorrow? Get it out of your head and onto the page. Step 4. Pre-market prep. Another 5 to 10 minutes. Note your key levels, tomorrow's watch list, and any red flag news events. Decide your plan in advance. Case study, the sleep upgrade. One trader used to toss and turn all night, replaying charts in their head. After adopting a shutdown routine, their sleep improved, morning anxiety vanished, and execution quality went up. Why? Because every day started clean. The psychological payoff is huge. It reduces overthinking. Your brain relaxes once it knows the work is complete. It protects confidence. You separate one day's results from your identity. And it accelerates learning. Reviewing patterns daily makes your brain faster at spotting them live. Advanced edge. Visual shutdown cues. Create a physical signal that the day's done. Close every platform. Move your journal to the close folder. Turn off alerts. Train your brain. When the ritual ends, trading mode is off. Avoid the common mistakes. Skipping review after a winning day, that's when ego blinds you most. Doing it in your head instead of writing. Memory lies, notes don't. Starting prep in the morning. Mornings are for execution, not scrambling. Action step. Build your shutdown template. Ask yourself every evening, did I follow my plan today? What was my best trade and why? What was my worst and why? What's the one thing I'll do better tomorrow? Here's a 1 to 100K connection. Ending each day clean prevents small mistakes from snowballing into equity damage. Your curve stays smoother, your mind stays sharper, and compounding keeps rolling. Final thought for chapter 19. Winning tomorrow starts tonight. A clear head sleeps well. A well-slept trader executes well. And a well-executed plan turns 1K to 100K dollars. In chapter 20, we'll finish the core section with the no strategy, the mindset shift, where your edge comes from execution, not from endlessly chasing the perfect system. Chapter 20, the no strategy, why execution beats system hopping. Every losing trader thinks the problem is their strategy. Every winning trader knows the strategy is fine, it's them that needs fixing. Here's the trap, system hopping. You hit a losing streak and instantly search for a new indicator, a new YouTube holy grail, a new signal group, and so the cycle repeats. Nothing ever sticks because nothing ever gets enough time to prove its edge. The truth? Many strategies can be profitable if you execute them consistently with proper risk. Your win rate, your double R, your discipline, they matter more than your entry pattern. The market doesn't pay you for originality, it pays you for execution. Case study, the 3-system spiral. A trader ran through 3 different systems in 6 months, never more than 30 trades each. No time for any statistical edge to show. They felt like nothing works, when the truth was, they never worked anything properly. After finally committing to one strategy for 200 trades, their results flipped from -7% to +14% in under a year. This is the no strategy mindset. You stop asking, what's the best system? And you start asking, how can I execute my current system flawlessly? The focus shifts from chasing new tools to mastering the ones you already have. Why does this accelerate the 1 to 100K journey? Because consistency compounds faster than experimentation. Because reliable data refines your edge. And because you avoid the emotional swings of starting over every time. How to commit to the no strategy. Step 1. Pick your system. Choose one that fits your personality trend or mean reversion, scalping or swing. It doesn't need to be perfect. It needs to be one you're willing to execute for 6 to 12 months. Step 2. Define rules in writing. Entry, stop, target, position size, market conditions. No gut feel until the rules are mastered. Step 3. Log 100 to 200 trades before you judge it. That's the bare minimum for a real verdict. Advanced edge, the rule lock period. For the first 100 trades, you don't change a thing. After that, refine one variable at a time, just like we covered in the monthly reset. The psychology shift is massive. When you stop chasing better systems, your brain stops thinking every loss means start over. It starts focusing on executing better. and it builds confidence from seeing stability over time. Case study: the execution first trader. One trader using a basic moving average crossover was break even for months. Instead of switching, they focused on execution, waiting for cleaner setups, avoiding new spikes, cutting tilt trades. Same system, same signals. 9 months later, plus 22%. Action step: write your no strategy commitment contract. For the next 200 trades, I commit to trading only X strategy name under Y-defined rules. I will judge its performance only after completing this sample size, not before. Sign it, date it, pin it to your desk. Here's the 1 to 100K connection. You don't need the perfect system to reach 100K. You need a good enough system, executed with perfect discipline. Final thought for chapter 20. The Holy Grail isn't a strategy. It's the trader who can execute any decent system without flinching, without tilting, without quitting after losing week. With this, the core content phase is complete. Next, we move into the climax, the most emotional, powerful truth that ties the entire $1 to $100K journey together. Climax: the moment you realize it was never about the money. Imagine this. It's late. The platform is closed. You're staring at your account, and it says $100,472. You made it. From $1,000 to $100,000. The plan worked, but here's the plot twist. It's not the number that matters. It's who you became on the way here. When you started, $100,000 felt impossible. You thought the challenge was finding the right trades. But somewhere along the road, you realized the real challenge was becoming the trader who could survive the climb. The $100,000 wasn't built from one lucky month. It was built from the days you sat on your hands while everyone else forced trades, the weeks you clawed back from drawdowns without revenge trading, the hundreds of times you followed your rules when breaking them would have felt so much easier. And here's the truth. If I could take away your $100,000 right now, you'd still be rich. Because now you own something more valuable than any balance. A process that works. A mind that stays calm under pressure. The discipline to do the hard thing when no one's watching. That's why 99% of traders never make it. Not because they can't learn setups, but because they can't learn patience. And that's the lesson that changes everything. This journey was never about speed, never about brilliance. It was about building an unshakable foundation, brick by brick, trade by trade, month by month. Every chapter from micro milestones to no trade days wasn't just about growing your account. It was training. Training for the one skill that matters most, self-mastery. And now you see it clearly. The same discipline that built $100,000 can build $500,000, can build $1 million, any number you choose. Because here's the ultimate truth. The goal was never $100,000. The goal was to become the trader who could make it and keep it. Outro: this is just the beginning. So here you are, at the end of the $1,000 to $100,000 plan. You've seen the tools, you've felt the shifts, you've tasted the mindset change. But here's the hard truth. Reading this won't change your life. Thinking about this won't grow your account. Execution will. One trade at a time. One journal entry at a time. One disciplined decision at a time. And that's the real edge you own now. Not the setups, not the math, but the process. A process that strips away guesswork, emotion, and self-sabotage. You've built patience to wait for your setups, resilience to bounce back from drawdowns, clarity to know when not to trade. That's what separates pros from gamblers. And now, this is your fork in the road. You can close this video, go back to random trades and emotional tilts. Or you can commit right now to running this plan until it becomes second nature. So here's what I want you to do. Subscribe to Disciplined Trades, keep rewiring your brain to think like a pro. Like this video if you know this plan can work for you. Comment below with the first rule from this plan you'll implement. I want to hear it. And share this with a one trader friend you know who needs this wake-up call. Because here's the final truth. The market will test you. Your patience will be pushed. Your emotions will try to drag you off plan. But every disciplined decision you make is a deposit into the account that matters most. not your broker account, your future self. This isn't the end of your $1,000 to $100,000 journey. This is a first step toward becoming the trader who can go beyond it.